All right, everybody. Today's video, I'm going to talk about what the big deal is with S Corps and why people love them. Now, you're probably like, oh gosh, this is going to be boring. I'm going to try to make it entertaining as I can. Now, I don't have music and all this other crap like, I don't know, a one-man show, man. So I do what I can. I'm here to teach and I'm here to help you understand various topics in personal finance. That is my goal. Before I go any further, there are 4 simple things I want you to do if you enjoy my content. Number 1, hit the like button. Doesn't cost you anything. Shoot your little thumb and do that. 2, subscribe to the channel. 3, hit the bell so that you get alerted when new videos come out. And then lastly, share it with your friends because everyone needs to know this stuff. It's important and I want the word to spread around. So spread the word. Share the wealth. Don't be a hog. Share the wealth. So anyway, enough of me rambling here. So I want to talk about what the big deal is. And you've probably seen it on social media. Everyone tells me I need to be an S Corp. And the way that this comes up is like you started a business and you're making some profit. And so you're probably looking at like, okay, am I organized the optimal way? Do I need, is it okay to be a sole proprietor? Should I be an S Corp? Everyone says I should be an S Corp. Well, I'm going to explain why. So here's the deal. Here's the deal, okay? When you have a W-2, and for those of you that don't know, a W-2 is the form you get if you work a job. So you work a 9 to 5. At the end of the year, you're going to get a W-2. On there, it's going to have your wages. It's going to have Social Security, and it's going to have Medicare. Okay? It's going to have those lines in there, okay? And you paid in some Social Security and Medicare. Now, what did you pay in? So, for Social Security, you paid in 6.2% up to, I want to say it's like 140, I don't know, I'm going to say 140. I might be off a couple thousand, but whatever. I mean, for this example, we're going to go with it, okay? Yeah, I know someone's going to be on there. Well, that's not the exact number. It's like 145. Okay, sue me. I don't know the number off the top of my head. That is, so after you pass that cap, that 140, you're not going to pay any more Social Security. You're topped. You're topped out. You won't pay any more. You can make $1 million a year and you will pay the same amount of Social Security tax as someone making 140. So there you go. The Medicare is 1.45% and there is no cap. And again, once you get above certain payroll, certain pay, I think it's 200. It might be 250. I don't remember now. It's been a long day. You have to pay an additional 0.9%. So, but we're just going to, like I said, we're keeping it simple. I'm not trying to overcomplicate it. I'm trying to keep it simple. This is not tax 501. This is tax 101. And I want you guys to understand the basics. So, if you take your paycheck and you take your W-2 at the end of the year, you're going to see those items on there. What you don't see is these items here. Your employer, I can't even write. I have to get in front of the camera. Your employer pays them also. So not only are you paying in your amount, your employer is matching that amount. Now, they're not doing that out of the kindness of their own heart. They're doing that because that's what is required. They pay 6.2. You pay 6.2. That's how this works. They pay 1.45 for Medicare. You pay 1.45. Now, unemployment insurance, all that's paid for by the employer. So, you have 2 components of this. 2, you just don't see that other one because your employer is paying for it. You might see it in the form of, well, I could have made more money if my employer didn't have to pay in all these payroll taxes, and that might be true, but this is what you see. You see this, but the big picture is all of this, okay? Sorry, I didn't mean to circle that, but like that's the whole point. So let's go. Let me clean all this up because it's getting all messy. Okay. So now you say, screw the rat race, I'm leaving. And now I'm self-employed, right? I don't know if I spelled employed right, but oh well. You're self-employed, like you're Mr. Big Shot now. No more boss to answer to unless it's your own. Then I could be my own worst boss. But anyway, you're self-employed. So now you pay both. That's why sometimes you see on those returns, like if you start your own business and you're a sole proprietor, your income is going to flow to your personal income tax return. Again, we're assuming the basics here. And what you'll see is you'll look and you'll be like, okay, I made $10,000 of profit. So now why do I have $1,530 that I have to pay in self-employment tax? Well, because you're paying 1.45% of Medicare, but you also have to pay the employer portion because you are the employer and the employee. You pay both sides. So now you're going to have this plus the income tax, and maybe you're in the 22% bracket. So now you have $2,200 there. So now you have $3,730 that you're paying on $10,000 of profit. You have a lot of tax. This is a problem when you're self-employed. This tax, you have self-employment tax. Because all of your profits, all 10,000 of that, is subject to it. Now, if you have a W-2, let's say you max out, let's say you make 140, you max out your Social Security, and then you go and do a side hustle, well, you're not going to pay Social Security on that because it's above your cap. Like 140 is for all your wages, including self-employment. But for most people, that doesn't apply. Like they're going to pay self-employment on all of that. So that's the thing that people have to understand is when you go on your own, that can be a big tax to deal with. And you'll have people that'll make $100,000 in profit and they're like, yeah, man, I can spend all this money. And they don't realize, like, whoa. You might have like 30% of that between income tax and self-employment tax coming out. You didn't get $100,000. Government's going to take their cut, and they'll get their cut. Always do. So you're like, well, screw that. So now you do this. Now you're like smart because you're watching this video. Okay? And you look at an S Corp. And you're like, well, I'm going to be an S Corp. So how does that work? Well, S Corp has certain rules. You have to have under 100 shareholders. There's limitations on who can be a shareholder, but we're just going to keep it simple. You're your own shareholder. You own 100% of the company, 100% of the corporation, of the S Corp. You own 100% of it. Now, what this means with an S Corp, you're going to have two components, okay? The first component is you're going to pay yourself a W-2. And let's say your profit, let's just say it's $100,000, okay? Say your profit's $100,000, right? Easy math. In the S Corp, you have to pay yourself a wage. Now, how much do you make? I don't know. You have to decide. Let me say this. You need to be reasonable. Do not go and tell me that you're a car mechanic and you're making minimum wage, or you're a doctor making $30,000 a year, or you're an engineer making $20,000 a year and you have 20 years of experience. These are not reasonable examples. Be reasonable. Maybe an accountant with 20 years of experience, I don't know, maybe they're making $150K or $130K or $100K, whatever it is. Depends on your town and all that. Just have a reasonable wage that makes sense. But let's say, in this case, you say a reasonable wage is $50K. Okay? And this profit is, I'm going to use it before, this is before your salary. Okay? So you take this W-2 of $50,000, not 50, 50,000. You made more than $50. You made 50,000. Now, you will pay, I'm going to abbreviate self-fee for self-employment. You're going to pay self-employment tax on that. Okay? You're going to pay that full 15.3%. You're going to pay it on that 50 grand. Now, what has happened that's different than before? Well, before, you were not an S Corp. You were just a sole proprietor. This entire 100K, you had to pay the 15.3 self-employment tax on. You had to pay it on all of it, all the 100K. Now you're only paying on half. So you can already see there's savings there. So now you're like, well, Matt, where's the other 50K? Where does this other 50K that I had in profit? I cannot write sideways, I'll tell you that. Where's that other 50K? Where did that go? Well, that goes to you as a distribution. That's a distribution. Subject to only income tax. So you are paying income tax on that $100,000, but you're not paying self-employment tax, that 15.3%. You're only paying that on half. This is why people love the S Corps. They love it because they can save on self-employment tax. They do. And this is so when people yap about it online, that is the big deal. Now, I want you to pay attention here because there are some considerations. Payroll cost. I'm going to talk about these first two. So let's talk about two things that you will have to have when it comes to an S Corp. You're going to have payroll, and you're going to have to prepare a Form 1120-S. I do not recommend doing that on your own. Get a good CPA to help you with that. But for payroll, you can use Gusto, ADP. They all have programs. You pay them a little bit of money a month, and they will help you with payroll filings. Because not only are you going to have this, like you're going to have, payroll tax returns, which are 940 and 941s. This is unemployment. That's your withholding. You're going to have to file those. You're also going to have state unemployment. And you might have like workers' comp. You're going to have other returns. So I strongly recommend you get a payroll processor to do this. Pay them a little bit per month, but just know that that is a cost of doing business. You will have additional costs. A tax return with an 1120-S, it might cost you $1,000 or $2,000. But again, well worth it to free up your time. You're also, because of those first two, and I want to repeat this applies regardless. I'm sorry, it's a little messy here. I abbreviated and shortcutted it, but keep good records. Don't be a slack on this. Do not slack on this. You want to keep good records. You want to keep good records no matter what. State considerations. I say this because this is an important thing that a lot of people, they just immediately run off and do an S Corp. And they don't realize, for example, in Tennessee, you have what's called a franchise and excise tax. Franchise is based on your net worth of the company, not your net worth, but the net worth of the company. And then you have the excise tax, which is a 6.5% income tax. The problem is when you have that tax, income that is subject to self-employment is exempt from that tax. So that's awesome, right? So my example where you're a sole proprietor and you're making 100 grand a year, guess what? You don't have to pay the excise tax. It's all exempt. In the other example where 50 of it is through you're paying yourself a salary, the other 50 is a distribution, you have to pay that 6.5% tax on that. What that does is that greatly reduces the tax savings that you get from an S Corp. And that is something to be mindful of. Also, if you have an S Corp and let's say your salary is over the Social Security cap, let's say you have a W-2 and you're doing this on the side and the salary is way over the cap, well, at that point, you're only paying the 2.9%, plus if you have any additional Medicare tax, like that 0.9%, you might have that. But you're not saving as much money as you think you are because you're already over the Social Security cap. So that is something to keep in mind with S Corps. Like, your personal situation very, very, very much matters. Do not just take some bozo on Twitter, well, they told me I need to get an S Corp. Oh my gosh, I saw this cool reel. Oh my gosh, I gotta do it right now. Think, talk to your CPA, do your research, make sure it's right for you, where you live. You probably just need to have a CPA help you with that. But this is important because too many people do this and then they don't realize this. And then the other last thing I want you to do not put rentals in one. Okay? Do not ever do this. Do not. If you have a rental property that you just collect your rent on every month, do not put them in an S Corp. Why? Because when you take it out, it is a taxable event. It is basically the same as if you had sold that house, even if you just transferred it back to yourself and you own 100% of the S Corp. No, don't do that. You don't want to do that. Do not put rentals in there. Don't do it. Now, if you're flipping houses, that's a different story. The other thing too that this does, if you do this, like rental income, no SE tax. Generally, like rental income, like if you have a beach condo and you're just renting that out, it doesn't have self-employment tax. The minute I put this in an S Corp, I have to pay myself a wage. So I have taken income that didn't have self-employment tax, and now it does have self-employment tax, or at least some component of it. So please do not do that either. These are, like I said, these are some basic tips. And so here's the deal. I want to help educate you, and I wanted to introduce you to the S Corp so that at least you understood at a very basic level what people are talking about when they talk about them. So hopefully this explained everything. If you have any questions, be sure to follow me on Instagram, mdeepcpa. It's MDEEPE CPA. Or you can follow me on Twitter, mdeep_CPA. Spelled the same, just has a little underline between the deep and the CPA. So hopefully you enjoyed this and have a fantastic night.